The yield curve, what bond pricing indicates. Hey everyone, welcome back to the channel. Today we're diving into a super important concept in finance, the yield curve. You may have heard about it in the news, especially during times of economic uncertainty, but what does it actually mean? And why does it matter to the markets and to you? Welcome to the channel. My name is Anthony Gismondi, Senior Wealth Advisor, Aegis Wealth Management, a part of Wellington Altus Private Wealth. The goal of our channel is to educate Canadians on the complexities of personal finance and to provide clarity to help them reach their goals. If you're new to the channel, please make sure to subscribe and click the like button. By the end of this video, you'll understand how bonds work, what the yield curve is, the different shapes it can take, and why economists and investors watch it so closely. Let's get started. What are bonds and how do they work? A bond is essentially a loan. But instead of a bank lending you the money, you lend money to a government or a company. In return, they pay you interest over time, and then they return the original amount, called the principal, at the end of the bond's term. This period is known as the bond's term to maturity. Bonds can be traded. If you bought a government bond for $1,000, you could sell it to another investor in the bond market. And just like stocks, the price of the bond can go up or down, depending on market conditions. But how does that affect your return? That's where bond yield comes in. The yield is the return an investor earns from holding the bond. If the bond's price goes up, its yield goes down, and vice versa. Let's say you buy a $100 bond that pays $2 a year. That's a 2% yield. If the market rates fall and investors are now okay earning just 1%, they'll be willing to pay more, say $109.50, for that same bond paying $2 a year. So, while interest rate payments stay the same, the yield drops because the price went up. What is the yield curve? The yield curve is simply a graph that shows the yields of government bonds across different maturities, from short-term to long-term. The cash rate, or policy interest rate, forms the starting point of the curve. Because government bonds are considered risk-free, the yield curve is often called the risk-free yield curve. To build this curve, we plot the yield for, say, 1-year, 3-year, 10-year, and 30-year bonds along the x-axis, with the yield percentage on the y-axis. The shape of this curve gives us a snapshot of investor sentiment and economic expectations. Shapes of the yield curve and what they mean. Normal yield curve. This is the most common shape. Short-term yields are lower than the long-term ones, creating an upward slope. It suggests that the economy is growing and inflation might rise, so future interest rates are expected to be higher. Inverted yield curve. Here, short-term yields are higher than the long ones. This is rare and often seen as a red flag. Why? Because investors expect future rates to be lower, which often happens before a recession. A flat yield curve. This occurs when short and long-term yields are similar. It usually means the economy is in a transitional phase, neither growing rapidly nor shrinking. Why the yield curve matters. Monetary policy transmission. The yield curve shows how central bank policy, like changing interest rates, spreads across the economy. For example, banks use yields to price mortgages and loans. If yields on a 3-year bond rise, the fixed-rate mortgages might get more expensive. Investor expectations. The curve tells us what the market expects for future growth, inflation, and interest rates. A steep curve means optimism. A flat or inverted curve might be preparing for some rough times. Bank profitability. Banks borrow short-term and lend long-term. A steeper curve usually means they earn more from that difference, known as the margin. A flatter curve, that squeezes profits. What can cause the yield curve to change? Monetary policy changes. Central banks can directly influence the yield curve. Raising the policy rate moves the short end of the yield curve up. Forward guidance or bond buying programs can flatten or steepen parts of the curve. Investor risk perceptions. Yields change if investors see more risk, like credit risk, which means default, liquidity risk, which means hard to sell, or term risk, which means locking in a fixed rate while interest rates rise. If risk perceptions change, so will yields and the shape of the curve. Supply and demand for bonds. If the government suddenly issues a lot more long-term bonds, their price may drop, and yields may rise, causing the yield curve to steepen. Investor risks. Investors face several risks when holding bonds. Number 1, credit risk. The borrower may default. Number 2, liquidity risk. You might not be able to sell the bond easily. Number 3, term risk. If rates rise, long-term bond prices fall. Understanding these risks is crucial because they affect bond yields and ultimately the yield curve. So there you have it. The yield curve isn't just a boring line on a graph. It's a powerful economic signal used by investors, analysts, and central banks alike. Whether you're an investor, a policymaker, or just curious about the economy, keeping an eye on the yield curve can give you valuable insights.